discussing options in today's call.
Okay, first to demonstrate how call options work, I'm going to tell you a little story. And by the way, if calls and puts are old hat to you, then you've already got a leg up. So the method I'm going to teach you afterward will be even easier for you to apply with options. Okay, here we go. So Susie's selling her house for $500,000 in a neighborhood that has a nearby parcel of land that is for sale as well. There are two parties interested in the land. Peter plans to develop the land into a beautiful park and bird sanctuary. And Harry plans to build a low-cost housing development. Now, Sammy comes along and is interested in buying Susie's house for a cash deal. But he has a problem. He won't have the cash available for 3 months. So he's, of course, worried that the house will be sold to someone else in the meantime. So he decides to offer Susie $5,000, or the option premium, right now, if she'll take the house off the market and give him the option. This would be a call option to buy the house for $500,000. Is referred to as the strike price, anytime within the next 3 months, which is the expiration date. Now, if he does not elect to buy the house, Susie keeps the $5,000 premium and Sammy walks away from the deal. If he does elect to buy the house or exercise the option, Susie still gets to keep the $5,000 and he pays her $500,000 for the house. Now, 3 things could happen in this story. In scenario 1, Peter buys the nearby parcel of land. This, of course, will increase the value of Susie's home to, say, $600,000, in which case Sammy will be very happy to exercise his option to buy the house for $500,000. In scenario 2, Harry buys the nearby parcel of land. This, of course, will decrease the value of Susie's home to, say, $400,000, in which case Sammy will not exercise his option to buy at $500,000, and he'll just walk away from the deal having lost only $5,000. And there's scenario 3, where neither party buys the nearby parcel of land. Susie's house is still worth $500,000, and Sammy can elect to exercise his option to buy the house for $500,000 or not and simply walk away from the deal, losing only $5,000. In effect, Sammy is controlling a $500,000 asset for 3 months for only $5,000. No matter what happens during that time, the most he can lose is $5,000. Susie, on the other hand, is happy to take the $5,000 as she had no guarantee anyone else would buy the house at her asking price, nor did she feel the nearby parcel of land would sell anytime soon. Here's a footnote to the story. Depending on the circumstances, if Susie felt she was likely to attract another buyer in the near term, she would have demanded more than $5,000 from Sammy to take the house off the market for 3 months. Likewise, with call options, the more the underlying asset is perceived to appreciate, the higher the premium demanded by the market for that call option. So now let's define this in trading terms and look at an actual example trade. Call option is a contract between 2 parties to exchange a stock at a strike price by a predetermined date. One party, the buyer of the call, has the right but not an obligation to buy the stock at the strike price by the future date. While the other party, the seller of the call, has the obligation to sell the stock to the buyer at the strike price if the buyer exercises the option. For example, if a stock is trading at $50 and you think it's going to go up to $60, you might buy a $55 call option for, say, 20 cents. If the stock rose to $60, that would allow you to buy the stock at $55 even though it's valued at $60, netting you a $4.80 profit on each share. On the other hand, the person that sold you the call would be obligated to sell you the stock at $55 at a loss of $4.80. If the stock never rises above $55 by expiration date, the call expires worthless. And the call buyer is out 20 cents and the call seller keeps the 20 cents. Okay, now let's look.
Guys, were you able to understand this example over here? Any questions, any doubt regarding this example?
All clear.
Crystal, bro.
All right. Anyone else? And don't worry about where is that example?
The nearby parcel of land would sell. Susie felt she was from Sammy to take with call option premium demanded by one party, the buyer of the call option, to buy, well, the other party, for example, if a stock is trading.
Do you guys understand how the profit was calculated over here? When the value rose to $60, why was the profit only $4.80 and not the entire $5?
Minus
Anyone?
the 20% premium.
Right. Everyone understands like why the premium was subtracted while calculating the profit.
Because you pay for it upfront.
Sorry.
Because you pay for it upfront.
Correct. That's correct. We're discussing more about call and put options in the slide after we watch the video. So let's end this video.
$50.20. If the stock rose to $60, even though it's better to sell you the stock at about $55, the seller keeps the 20 cents. From our earlier story, Sammy owns a truck worth $40,000. He's concerned that his truck might be damaged in an accident or even stolen. So Sammy decides to buy a zero deductible insurance policy or a put option on the truck for the full amount of $40,000, which would be the strike price, from Susie's auto insurance company. Susie charges him $1,500. That would be the option premium for a 1-year policy, 1 year being the expiration date. Now, 3 things could happen in this story. In the first scenario, Sammy's truck is not damaged or stolen during the year. So Susie keeps the $1,500 premium. Sammy's okay with losing the $1,500 for the protection it provided him for the year. In scenario 2, Sammy's truck is damaged in an accident, requiring $10,000 in repairs. He exercises his insurance policy or his put option by filing a claim, and Susie pays him $10,000 for the repairs as agreed. Sammy is happy he purchased protection for this possibility. In the third scenario, Sammy's truck is stolen. He exercises his insurance policy, which is his put option, and files a claim, but this time for the full replacement value of his truck. And Susie pays him the full amount of $40,000 to buy a new truck. Sammy, of course, is very happy he purchased protection for this possibility. In any case, Susie's happy because she sold many such insurance policies, different put options, to other drivers, most which never filed a claim or never exercised their options, providing her with a net profit overall. And here's a footnote to this story. If Sammy had a poor driving record, that's more a risk to Susie, so she would have charged him more than $1,500 for the 1-year insurance policy. On the other hand, if Sammy had an exemplary driving record, Susie could have charged him less, as the risk would be lower. Likewise, with put options, the higher the perceived risk, the higher the premium demanded by the market. Let's look again at a definition and a trading example. A put option, then, is a contract between 2 parties to exchange a stock or an ETF at a strike price by a predetermined date. One party, the buyer of the put, has the right but not an obligation to sell the stock at the strike price by the future date. While the other party, the seller of the put, has the obligation to buy the stock from the buyer at the strike price if the buyer exercises the option. For example, if a stock is trading at $50 and you think it's going to go down to $40, you might buy a $45 put option for, say, 20 cents. Stock dropped to $40. That would allow you to sell the stock at $45, even though it's valued at $40, netting you a $4.80 profit on each share. On the other hand, the person that sold you the put would be obligated to buy the stock from you at $45 at a loss of $4.80. If the stock never drops below $45 by expiration date, the put expires worthless and the put buyer is out 20 cents and the put seller keeps the 20 cents. Thanks for watching this video and I hope you enjoyed it.
Alright, guys. Do anyone have any question regarding the regarding put option and the example we just saw?
I had a question about the second possibility, where Sammy has right. He's bought the put option from Susie for 1 year for $40,000, which is the total worth of the vehicle. But in the second option, when he has an accident and the repairs only cost $10,000, and he exercises his right to he exercises the option and he only gets 10,000. What happens to the remaining 30,000, or is that purely part of the analogy and we don't need to worry about that?
So over here, like since the person who is trying to explain the video, he mixed up insurance and put option. So that's only for analogy over here, and he's like sticking to insurance policy and how they work while trying to explain put option. Like basically when you're
Oh,
getting an insurance over your car, so even if your damage is only for if your damage is only till $10,000, so even though your insurance might cover up to $50,000, but at that particular moment only that those damage would be like repaired back or reimbursed to you. So over here only $10,000 damage was done, so he could only you could take it in another way. So his car is $40,000 as according to the example. All right, he has some minor dents across the car and minor damages. So his car value has dropped to $30,000. That's why he can claim the insurance for that difference of $10,000 and he can repair his car back and make it brand new. So if he wants
got
to
it.
say,
Yeah,
you got it?
that's a better way of looking at it. Yeah, thanks.
All right, guys, let's again go through call and put options. So first of all, what are options?
Are you live?
Sorry, right? An option is a derivative financial instrument that specifies a contract between two parties for a future transaction on an asset at a predetermined price. Options give the buyer the right but not the obligation to buy or sell an asset at a specified price at any time during the life of the contract. Guys, please, emphasis on this particular point. The option buyer, whether it's a call option buyer or a put option buyer, they have the right but not the obligation to exercise their right at a future period. And the reason they get that right is because they are paying a premium, which we saw in previous two example. Like for the house, it was around $5,000, and for the car, it was $1,500. So that premium, that money that they are paying to get that right is known as option premium. Call option. So a call option is a right but not an obligation to buy an asset at a predetermined price within the specified time. So, a holder of a call option exercises the option when price of underlying asset is more than the strike price. Uh, before we go with analogies, acronyms over here, so strike price is the price agreed upon while getting into the contract. Whereas we may come across spot price ahead. So spot price is the price in the future. Like let's say we get into a contract for 3 months. I buy a call option from you guys. So after 3 months, the price of that underlying asset would be called a spot price. Moving ahead with the example, so holder of a call option exercises the option when price of underlying asset is more and he can get profit. At that time only he will use his right to exercise that call option. We can compare to that house example where Semi, when in the nearby land a bird sanctuary was being developed. Only at that time the buyer of the call option, he was willing to buy the house for because he logged in the house value at $500,000 and the value shot up to $600,000 due to the nearby bird sanctuary. During that, only that time he was willing to exercise his right and buy the house at $100,000 discount basically because he had a call option on that house. Basically, a call option will only be exercised when the future price, that is a spot price, is higher than the strike price. The formula to calculate the profit is, it might look a bit technical, but it's quite simple, and you'll just get the hang by reading the example. The formula is profit is equal to spot price minus strike price minus option premium. Discuss an example over here. Guys, like I want you to answer all of these questions. Let's consider you guys buy a call option to buy Tesla shares after 3 months at $1,000 strike price by paying a premium of $25. So in the first scenario, after 3 months, the price of Tesla share has risen to $1,200. The first question is, will you exercise the right? If yes, then what would be the profit or loss?
Yes, $200 profit.
Okay.
Hmm.
Anyone else?
Wouldn't it be
Yes,
yes, but
$175 profit.
yeah,
Well, actually, $19. I mean, 1900. Sorry, I'm still having insomnia, but minus the option premium. I mean,
It's 200 minus the
175.
premium, so 175.
yeah, exactly.
I go with 175.
No, but
Any other answers?
so okay. The strike price is 1,000, and you're paying a premium of $25. That is so. If it's 1,200, you're making a profit of $200, right?
Nah, I don't think so.
It's
That's
175
partially
because
correct.
Yeah,
you're
minus
paying
the
20.
premium. Okay, yes.
Yes. So, guys, the answer is $175. Basically, since you have the right to buy that asset at $4,000, and the price of that asset in a market is $200. You will exercise your right and you'll buy the Tesla share for $1,000. So you're netting a profit of $200, but paid a premium of $25 upfront 3 months before, like earlier when you were getting into this contract. So we have to factor that as well. So net profit comes to 200 minus 25, that is $175. Second scenario is quite interesting. I want to know the after 3 months Tesla shares price is $1,020. The first question, will you be exercising your right? And what would be your profit or loss? Think over it. It's a good
So
question.
it doesn't make any sense to do it because you'll still be in loss, right?
I think I would do it, and I would still lose $5. But if I
Yeah.
didn't do it, I would lose 25. So I would exercise the option.
Any other answers?
For me, the loss isn't that much. It's going to be just $5 loss. So I would definitely exercise my rights. I will still go with the price.
You can still buy it at the spot price, like without the option. So like you're losing money with this option. The option uh, isn't in the money.
Alright, so I'll just answer it. So you aren't actually losing money if you exercise your right. So in the market, Tesla is trading at $1,000, $20. You could buy those shares for $1,000. Will you buy that or not? Getting a $20 discount basically, so you'll definitely buy that. So you'll exercise your right, but you will still be losing less money. If you do not exercise your right, you're losing entire $25. If you exercise your right, you're gaining $20 on this transaction over here, 1020 minus 1000 share, but you're losing when you factor in the premium that you paid 3 months ago. Your net loss is only $5 compared to it could have been $25 if you didn't exercise your right to buy the shares at $1,000. Confusion over these guys, or
Oh
it's
shit! It says 1020. I didn't even read that. I'm sorry.
no.
I thought it said 1000.
Is it clear, guys? This one?
Yeah, it is.
yep. It's that tricky one, but it's important to know. Yeah.
All right, so guys, I want to ask one question along scenario two. What would be the break-even price for this particular call option? Those who are already quite good with this topic, I would like them to not answer them directly. I'd like to other people who are learning this, they should go first.
I think 1,025.
That's the correct answer, yeah. So if the price after 3 months is 1025, you'll be making a profit of $25 if you just consider the strike price and the price after 3 months, but you already paid $25 upfront 3 months ago. Your net profit or loss is $0, so break even price is $1,025. Alright, guys, third scenario.
It's definitely a no for me. I'll rather just I won't buy the Tesla because then I will just lose $25. But if I buy it, I will be losing $125. So it's a no for me. I won't exercise my right here.
What would be your loss? You're not exercising a right?
25. 25.
Yep, that's correct. Coming to put options, so guys, like, do you have a good brief, like, basic overview on call options, or like, do you have any confusion? Would you like to go? Would you like me to go again on some concept over here? Oh,
I'm good from my side.
All the
right.
thanks.
Let's
All
move
clear.
ahead. Put option, similar to call option, but the things have, that's the like totally opposite from what we have learned at call option. So basically, a put option is a right, but not an obligation to sell an asset at a predetermined price within the specified time. Holder of a put option exercises the option when the price of the underlying asset has fallen and is less than the strike price. And like again, strike price is the value agreed upon while entering the contract. The profit over here is the formula is strike price minus spot price minus option premium. You don't need to remember this formula. You can directly by understand it by reading the example. Let's discuss this example. You buy a put option to sell Tesla shares after 3 months at $1,000 strike price by paying a premium of $25. We have scenario one. Price after 3 months is $1,200. So the same question: will you be exercising a right? If not, yes or no, what would be your profit or loss?
Wouldn't you not want to exercise your right here because the price has gone up and therefore you'd be out $200 plus the 25? Or maybe not out, but you'd be technically paying over.
Hmm.
Yeah, I agree. You would not want to exercise it.
Profit of $575.
Come again?
A profit of $575.
No,
No, in this
570.
case, you would be losing $25.
for I think for the first case, you'd be losing $225, right?
Mm, that's not the right answer. I'll cover it. So basically, when you buy a put option, you think at the future, after like in future, the price of that asset will fall down. You think you can buy that asset? You can sell that asset at a higher price. So when you got into this contract to sell Tesla shares after 3 months at $1,000, right? You thought that the price would go down, so you paid a premium of $25. After 3 months, the price is $1,200. So you can actually share your Tesla shares in the market at $1,200, whereas you got into a contract to sell those shares at $1,000. Definitely, you won't be selling, but that contract wasn't binding to you. You had the right to to back off from the contract because you paid a premium of $25 to have that particular right that you can back off from that contract anytime if the situation is not as per your is not favoring you. So in the first example, since you can easily sell the Tesla shares in the market at $1,200, so you'll be backing off from this first contract, the contract basically the put option that you bought for selling Tesla shares at $1,000. You won't be exercising your right. Only loss would be $25. You'll be losing on $25, and you'll rather sell Tesla shares in the market at $1,200 rather than selling to the put option seller at $1,000. Making sense, guys? Is it making sense?
Gotcha. That's actually, yeah. Forgot about the market part. My bad.
I cannot see the who was speaking because I'm sharing my screen. So who one person
Sorry,
said
that was
loss
me,
would be
Vedas.
one person said the loss would be $225. So I just want to make sure that he got his answer cleared over here.
Yeah, I think that was Psych who said that.
Sorry. Yeah, what I meant was if you exercise that, then it's going to be a loss of
Yeah,
$225.
yeah,
Sorry, I
that's correct. Yeah, so you'll not exercise your right. Scenario two, guys. What would be the profit or loss, and if you'll exercise your right, what do you think?
Sorry, I can't see the stream too well. Is it 1,000 as the current price after 3 months?
No, it's 1,020.
1,020, thanks.
Come on, guys, answer. Will you
I don't think
exercise your
you
right?
would exercise the right.
I would not exercise the right, and
You'd,
I would.
you'd be out $5 if you exercise the right, so it doesn't make sense.
So you would
But
lose
don't you
25, just like
lose?
the first example.
yeah. I
Yeah.
mean, if
Yeah,
you
it's the same
exercise,
as the first.
$45, so it doesn't make any sense.
Yes, that's the correct answer. So your loss would be capped at $25 and you will not exercise your right. So along scenario two, what is the break-even price of this put option?
975.
Yeah.
Everyone thinks
Um,
975 is the correct answer.
excuse me. What was the question?
Yeah. I'm asking others
Yeah,
Yes.
975.
1,025.
was that? Anyways, 975 is the correct answer. So if the price after 3 months is 975, you will be making profit by selling the share at $1,000. Whereas in the market, the price the share is trading at $975. So you made a profit of $25 by making the transaction, but you made a payment of $25 upfront premium 3 months ago. So overall, you'll be not making any money. That would be break even price. So that would be zero. 975 is the correct answer over here. So guys, scenario three, what is the profit or loss over here? And will you be exercising a right?
Sorry again. What's the price after 3 months for option three?
$900.
900. Got it. Thanks.
Is the issue with my my net bandwidth? Can any others see
No,
the
no,
screen?
no. It's my. I couldn't join the screen and join the stream in full screen, so it's in one corner of the grid. That's it's my bad.
All right.
Yeah, I got the same issue, but I can read it. Like it's 900, so 975, you get 75 profit.
Yeah.
That's correct.
If you guys are having trouble clicking the screen, if you just click Hitman's box, it'll open up on full screen for you.
Yeah. Sometimes it doesn't give you that option. Like even after you click join stream, it just glitches out. I think it's mostly on mobile, but don't hold me to that.
Yeah,
Yeah,
I
I
think
think
it's a
somebody
mobile
said
thing.
I think somebody said there's a 20 or 30% cap for how many people can view these.
Yeah, that's also there.
Wow, I didn't know this. All right, guys.
Well, you can still read
Do you
it.
have
It's fine.
we have covered the call and put options over here. I'm not going into too much technicalities and charts and all those stuff regarding call and put options payoff. because I think that might be confusing, and it will definitely take a lot of time. I'll definitely share the links to those videos, and you can watch them. And if you have any questions, you can DM me anytime. Like
I just want
basically,
to
like we
clarify one thing.
sure.
Like on an exchange, isn't it usually true that options are in contracts, and contracts are usually 100 shares, so you have to do this times 100, like everything you explained? Like I don't know any exchange that doesn't work in 100 shares for an option,
Like
like
so,
for
like
each
every
contract.
exchange they have the particular dollar value, so they set up number of shares according to that. So maybe New York Stock Exchange they want to make every contract worth $10,000. If a share is trading at $200, so they will calculate the number of shares according to that. So yeah, like you're correct. Every exchange has their own number of shares in the contract. But just to simplify the example, I just went with one share, make the
Yeah,
calculation
yeah.
simple.
But you got to remember that if you do sign a contract that has a 100 shares, the premium is also times 100.
That's correct.
And I mean, normally there'd be in terms of lots, like 1,000, 10,000, or whatever, depending on certain amount of lots.
We're talking about Tesla, yeah, it's in the 10,000s. Yeah.
Guys, I didn't cover one topic because I wasn't sure how well versed you guys are with call and put options, basically. So, like, we'll just have a brief chat over that. So, regarding option premium, so would anyone like to chime in regarding how the option premium is calculated?
I think I'd read it long back. I don't really remember, but there's a certain formula which is used to calculate it. I don't remember it now. What it was.
You mean the
I'm,
Black-Scholes
I'm
method?
even I'm not that well versed regarding the formula, but I'm asking in general sense, what would affect the option premium?
I mean,
Well,
the
if
time.
it's sorry,
Sorry.
go ahead.
How many shares you're buying?
The number of share doesn't impact that.
And again, the time factor, the time decay, which is one of the factors I remember, and uh, the closer
I
you
I
get
don't
to.
think that's the answer he's looking for. It's just how likely it is that the option will be in the money.
That's correct. So one factor is time, as someone mentioned. So like as closer as you get to the expiry, so the option premium gets closer to zero. And another thing would be so over here. So in the previous example where regarding in the house example that we saw in the video, so over there the person explaining he told like if there are a number of buyers interested in buying that property, then Susie will charge a higher premium rather than $5,000. She might charge $10,000 to take her house off the market. So over here, Tesla share is like basically trading at $1,000 right now. But let's say everyone is quite bullish about electric vehicles, and and like everyone believes Tesla will outperform all of its competitor, and it will easily reach a price of $1,100. $1,100 is a short target after 3 months. So if everyone is quite bullish about Tesla at that time, the premium would be $25. It might be around $75 to $80 because everyone believes that after 3 months the price is going to be above $1,100. Make sense?
So what you're saying is you could wait until the last minute to try and game the system.
No. If you wait till the last minute, the pre let me frame it 1 second.
Oh, I thought you said the premium is reduced the closer to the expiration. My bad.
So sorry, I made a mistake
I
over there. The premium isn't reduced. The premium is adjusted so that you are not going to profit if you are trading at the last minute. So in for example,
I
this particular sorry.
sorry. I just have a suggestion. I think those if you get into details of all those all those factors, it might be more prudent to do it in a separate class, because that's a huge topic in itself. If you cover all the delta, theta, and gamma factors, it's a never-ending topic, and I would rather suggest we discuss that in a separate class rather than doing it in this one.
He's just saying that
I
it
agree
will
to that,
rise,
yeah. But yeah, like
but he's just saying that it will
I'll also
rise.
clear
More
that we
likely
won't be
it is
covering
to.
delta, gamma, and all those in the next class because our focus is to cover UMA products as soon as we can. And I don't think we need to learn delta, gamma, and all those stuff to understand UMA products or have a basic overview. Yeah, like we can skip this part if anyone is interested, and like if the entire community wants to discuss about option premium and how it is calculated, then we can, yeah, we can surely we can plan a call for that. We'll discuss success tokens. Like anyone would like to chime in over here? I think we have Vairi as well on the call. He's great with all the technical stuff over here. So Vairi, if I make a mistake anywhere, please chime in and let me know.
Can I try it?
Sure.
Okay. Okay. So for a success token, you take you put one token at plus one premium, and then you mint that together. And let's say the strike. Let's say you the premium you buy it at like $9, and then it expires at like 24, and then if you hit $23 before, like as when it expires, you don't get the premium, you just lose out on it, but you still keep your that one token that was collateral.
Mm-hmm.
That's
Correct.
all.
But all right, like we'll try. I'll try to break it down for someone who doesn't know how success token works. And guys, sorry if I have a lisp with S word. All right. So success token provide a way for venture capital. VC stands for venture capital over here. So guys, before we get into this, so like before any DAO or any ICO, they go for ICO. They have Series A round where they pitch their project to venture capital, or basically first round seed A investors, and they buy those coins or a stake in that project by at a huge discount basically. But what about, let's say, like an example would be sushi. It is an already established project. Let's say we are a venture capital, and we want to invest huge amount of money into sushi because we believe sushi has a brighter future. So one option, which is the traditional option which sushi has, is they could offer us their coins at a discount. So let's say if sushi is trading at $25, and we are ready to invest around $100 million in sushi's, like basically in sushi. So they can give us a 10% discount. Basically, when the coin is trading at $25, we can buy all those coins at $22.50. But one problem with this is, the community is not happy with this. As you can guess already, because when the price is already trading at $25, the community is worried that if you sell these coins to sushi, if sushi sells this coin to venture capital for $22.50, they might dump it into the open market and might lead to price fall. Also, giving something at a discount when it is already trading at a higher price is not taken in a good manner by the community. So that's one particular issue. So this is where success tokens come around and acts as a savior over here. So we'll cover what success token is. So basically, success tokens are two tokens. One is the project token, whereas other is a call option on that token. So over here, like this means that instead of offering the venture capital investor a discount, we offer the investor a call option alongside their token purchase. They pay the full price of the token. So we'll discuss the sushi example in the next slide. So they pay the full price of the token for this purchase. The option portion is only valuable if the project rallies, which better aligns incentives. The venture capital investor only gets their bonus if the project performs well, which of course benefits the whole community. We'll discuss the example and then we'll have a question session, because if anyone has doubt, we'll clear that. So a venture capital, let's discuss this example. A venture capital is interested in investing in sushi. Current price of sushi is $25. So like a venture capital approaches sushi, and they are very good at increasing a project's value. They have a good track record. In whatever project they have participated, they have increased that project's value to a great extent. Giving them a discount on $25 directly, like upfront discount. They can be provided with success token, one sushi token plus one call option on sushi with strike price of $25. Venture capital brings value to sushi and price rises to $30. They will gain $5 from one sushi token plus $5 from the call option, because the strike price was $25 and now the price is $30. So they are easily making a profit of $5 from the call option. So a price increase of $5 is netting venture capital a profit of $10. So this is interesting for venture capital as well, because even venture capitalists, they are not interested to buy something from the open market. Even they would like some sort of extra benefit for participating in a DAO or in a project and increasing its value. So over here, like a normal investor would only profit $5, whereas a venture capital is profiting $10 if he is able to bring value. If venture capital fails to bring value to sushi and price falls to $24, the strike price falls $25. So basically, his call option will expire worthless and he'll be losing only $1 on one sushi token. Basically, like we by the help of success tokens, the venture capital is not getting any upfront benefit, because let's say if they are getting maybe 10%, 20% discount, if let's say if they are getting 20% discount, so on a price of $25, they are able to get sushi tokens for $20. So we are not even sure like if they would put those extra efforts to increase the project value, and the incentives might not align. But if we give a sushi token plus a call option on sushi, and if then they do not work and the price falls below 25, then they are not making any profit from the call option. Indeed, they are losing money from the token purchase. Like, is it making sense or getting too technical over here?
It's kind of interesting for me because it's kind of like in a way it's a parallel with the KPI option. I'm not gonna draw parallels, but I would also imagine that a project could choose to mint a success token, which obviously is their project token plus the call option, and actually sell it to the community at the market price now. And it's basically up to the community to choose to help rally the price in whatever way they can or want to, so that at the expiry time, when the price, if they're able to achieve the price increase, they've netted value not just on the project token, but also on the call option that they received with the success token. Am I right in my assumption over there?
That's correct. A project can definitely mint tokens, but it's like definitely better to get guidance from UMA, and we already have all those resources in place. Why would you like to chime in on this particular question?
Can I answer? Like at least try to answer.
Oh, go ahead.
Hi, I'm sorry. Could you repeat it? I was actually dealing with something else at the minute.
All right, just let me try and answer. Like success tokens are essentially also KPI options, because the example that Reuters just gave was a valid example. So are range
Yeah.
tokens. Like, these are all basically all KPI options. So yeah, you could use them to rally your community and
No, like Reuters, like I wouldn't say that these are KPI options, basically because it's indeed a purchase of sushi token over here with a call option as an added bonus. While the question that I want to answer is, like success tokens can be minted easily by any DAO. Like in this example, sushi can mint their own success tokens. Why would they need UMA over here?
They wouldn't need the UMA at all. We offer it as a service to support people to mint their tokens. And so we mint them on their behalf because we appreciate the protocols are busy and perhaps their team aren't as experienced as our team, so we can basically do it quicker on their behalf. But certainly they can. In
Right.
terms of range and success tokens being a form of KPI options, success tokens are essentially a KPI option, a very specific instantiation of them where the KPI is price. Range token isn't really, it's something a bit different.
Great. Thanks a lot, everyone, for adding on.
Got it. Like anyone, guys, like, do you understand how success token works and how is it better as compared to a traditional way of offering discount to venture capitalists? This is
You
important.
guys
Like, if you have any
covered.
question, we can go around from the start again.
So basically, what you're doing is you're making a bet, you're making a hedge based off of performance. And performance in this example would be defined by the reach of a specific KPI in terms of token price, a specific target in terms of token price.
That's correct. In this example over here, like we can, like in success tokens, we can easily set the parameters however the way we want. So in this example, I'll go again with this example. Current price of sushi is $25. So we are selling them success. Sushi is selling success tokens to VC. One sushi token plus one call option on sushi. So the strike price over here can be also $35, not the $25. Though the current price is $25, Sushi would say to the venture capital, like, if you think you can bring value above $35, or if the venture capital is promising that we will double your market cap, we have those assets and resources, and we think you are usually undervalued, then so basically Sushi will sell success token one in which there would be one Sushi token plus one call option on Sushi with strike price of $35 rather than just $25. So in this particular case, even the community would be happy because even they think if a VC is investing hundred of millions of dollar, and they will only get benefit if the price is above $35. So even the community feels that the asset is undervalued, and they would be happy if a venture capital is getting part of the project. Whereas if a venture capital is getting a discount, upfront discount, so that's not taken in a good way by the community. Make sense?
Sounds good to me.
I just wanted to um, uh, understand something for regular. For example, if you're giving tokens on discount, but you can always have timelines associated with them before which you really would not be able to sell the tokens, right? So, I mean, essentially, what my question is, how does success tokens bring more value compared to that? I mean, when you can always have agreements or bound the transfer or sale of those tokens.
That's a very good question indeed. So you're right, projects can also opt to sell tokens and provide a lock-in period of maybe 12 to 24 months. But if I'll give you two examples. So let's say in one example, Sushi is providing tokens at discount. And one more thing, as you mentioned, DAO or projects can give a lock-in period or vesting period and then go for the discount route. So in those particular case where maybe the lock-in period is for 12 to 24 months, the discount is quite huge from compared to the spot price. So in those particular case, the discount would be up to 25 to 30%. 30% on $25 is around like $17.50. So that VC is already getting tokens at $17.50. Many projects still prefer to go this way. But what do you think would be a better approach? In one option, if you think the VC is already in the money, or as we say, he's already in profit. If he sees his position, like he has $100 million worth of sushi tokens, which he bought at $17.5, whose current price is $25. Let's say he doesn't work for 1 or 2 years. He doesn't put any efforts for the DAO. He doesn't he doesn't bring any value. after those vesting period is over, like let's say after 2 years have passed by, the price is still at $25. No upward movement, no downward movement. And then what will happen? That VC will start dump. That VC can, since the vesting period has ended, he can legally, like, start dumping the token and easily make like 30% on $100 million, because he got a discount of 30%. So that would be around, he's making a profit of $30 million directly by not doing anything. Whereas if we go via the success token route, so I'd reiterate the same example. So we didn't offer him any upfront discount. So even if he wants to invest $100 million worth of money into sushi, so he'll be getting $100,000 worth divided by 25. That is around 25,000 shares of sushi, 25,000 coins. Sorry, 25,000 coins of sushi. So at expiry, like after 1 year or 2 year have passed, let's consider two scenario. In one scenario, the price is $30. Yes, the VC has bring a lot of value and really develop the company and valid the price to $30. In that case, he will be making a profit of $5 from each sushi token that he has. Sorry, but also $5 from the call option, because over here the call option is the kind of incentive, to get those venture capitals to work for the DAO. If there is no call option over here, then that's basically right, like any other holder. So like that wouldn't make sense for the VC to put in extra efforts, so bring value. If in this example I told $30, but what if the price doubles to $50? So if price goes from 25 to 50, the VC will be making a profit of $25 each, or $25 on each sushi token, plus he would also be making $25 profit on call option. So he would be making a profit of $50 on a price value of $25. So whereas if I am holding a sushi token at I bought it at $25, I'm a normal investor, and the price value to $50. So I would be making a profit of 100%. Whereas the VC, because he has put in a lot of efforts and he is a big investor in sushi, so he will be making a profit of 200%. Because on a price value of $25, he is netting a profit of $50 on per success token, which is a combination of one sushi token plus one call option on sushi token. Make sense?
Absolutely. I understand. It does. I mean, it would make the investor work for the money. So that's what I understand. It is good for the businesses, of course, compared to the traditional way.
Right.
Thank you.
Is there any question? Anyone else?
Good from my side. Thanks a lot, Attain.
All right, guys. Are you ready for the quiz?
Quiz time.
Oh yeah.
Where's the quiz in the text hub?
Yeah, in the text app. Everyone, we are having the quiz in the text app. I'll be starting it in a minute.